Hello, in this video I want to share with you how to win the money game using tax diversification. And as I mentioned in my previous video, you'll have no way of knowing what your tax liability will be in the future unless you have properly prepared well in advance. So now let's look at what tax diversification truly means. Right now, you're most likely earning money under tax code W-2 as an employee of a company, or you're earning money as a 1099, basically a self-employed individual. But in both cases, you're paying taxes now on the earnings that you're making every year. And this is considered, again, tax now. The next mode of taxation, what we call tax later. What falls into the tax later column? These would be things like your 401k, your IRA, and your SEP IRA. These are tax-deferred vehicles, also known as tax later plans. So you have tax now and you have tax later. Are you aware of any other tax category? Because there is one other category that the ultra wealthy know how to use, and they use it to their advantage. Let's dive into America's most common method of retirement and savings plan, a 401k. So what are the pros and cons of a 401k? Number one, the very first pro could be perhaps your company will match your contributions up to a certain amount. And this is free money, and obviously, in my opinion, one of the biggest reasons to participate in one of these plans. Number two, your money also compounds on a tax-deferred basis. Number three, your contributions decrease your taxable income liability each year. Number four, you can take money out in the event of a qualifying life emergency. So let's now look at some of the cons of a 401k plan. Number one, they have limited flexibility on where you can invest your money, meaning you cannot take your real estate property that you're renting out and stick it in a 401k plan like you can with an IRA. Number two, you will pay tax on the income when it's time to start taking the withdrawals out for retirement. And as you recall from my previous video about taxation and inflation, you truly don't know how large your estate's going to be at the time of retirement. So you have no idea what your tax rate's going to be, and it could get very expensive. And if you're not an extreme risk taker, would you really want to borrow money without knowing how much your interest rate's going to be when you have to go pay that money back? And again, if you don't know what I'm talking about, go watch my previous video. Number three, you have penalties for early withdrawals. If you run into a situation where you need the money that's sitting in your 401k plan, you can access those funds by paying a 10% early withdrawal fee and the taxes owed on the money that's taken out. But keep in mind, this sort of decision crushes your gains. And obviously you've been trying to gain on your 401k for likely many years. Number four, you have a cap on how much you can contribute to the plan. Number five, and here's the biggest kicker that a lot of people really don't know much about. You have what's called an RMD. An RMD stands for Required Minimum Distribution, meaning when you reach age 70 and a half, you're actually required to start pulling the money out of the plan. And these required withdrawals may seem harmless on the surface, but what they tend to do in your later years during retirement is they add to your taxable income amount. So this may bump you into a much higher tax bracket, further increasing your tax liability. And again, as we talked about before, we have no way of knowing what your tax rate's going to be 5, 10, 15, 20, 30, 40 years from now. And what happens if you fail to start taking those withdrawals from the plan at the time they tell you? They have a mechanism built in to ensure they get their money. And then what they'll actually do is hit you with a 50% penalty. So now let's quickly look at an individual retirement account and what it offers. So an individual retirement account offers a little more flexibility than a 401k. It offers more control to the account holder. It's not employer sponsored, so pretty much anyone can open an account. But some of the cons of an IRA include it is a very low contribution limit. There's no employer matching, and you still have the same exact required minimum distribution at age 70 and a half. And obviously that leaves you with an unknown tax amount when you actually reach retirement. So looking at these two retirement saving options, the big question you have to ask yourself is, do you want to pay taxes while you're young and life is mostly predictable? or when you're old, not working any longer, and your life conditions, at least as you sit here today, are basically unknown. Another critical question to ask yourself is this: what if something happens along the way? What if life happens? And between now and the age of retirement, you become disabled. Will your 401k or your IRA take care of you? Because you know your employer will not continue to employ you indefinitely if you become disabled or are unable to work. Your medical coverage and your nominal employer life insurance plan goes away, and you're basically stuck liquidating your savings to survive. So now let's switch gears. I want to share with you the third way to diversify on taxes. This tax diversification bucket is called tax advantaged. And what falls into this bucket? A Roth IRA and a 70-22 plan. In my next video, I'll go into the fine details of each one of these options, so I want you to stay tuned.